Welcome to the Treasury Update Podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to this edition of the Analyst Report Series. I'm joined by Craig Jeffery. We are going to talk about cash conversion cycle today, why our Fintechs are improving the P2P and the O2C processes a cash conversion cycle. Craig, welcome to the podcast.
Paul, it's good to be on the Treasury Update podcast, being asked questions by you. We've done a few before on the Analyst Report where I got to ask you the questions, try to stump you. That was fun.
Cash conversion cycle. This is something that's really important to organizations. Being able to get cash in the door in a timely manner, an appropriate way. They have payables, they have receivables. The receivables is uber important. You got to get cash in so you can pay your bills. So what is the cash conversion cycle? And Craig, why is it important to organizations and how can they manage it?
For those who are involved in supply chain finance, the cash conversion cycle heavily, you'll be pretty familiar with this. So you might want to jump forward a few minutes to the next section. But, cash goes into the cash conversion cycle. You put cash in when you buy inventory. When you sell something and you haven't been paid for it, you're funding that with your receivables, right? You sold it, you're waiting for a receivable. But you also use somebody else's cash with your payables, right? You buy something, you might have terms on it, you have to pay in 30 days, 60 days, or 90 days. And so now you're using someone else's material, products, goods, or services for a certain period of time. And so the cash conversion cycle is money goes in and comes out around a picture like a circle. Treasury sitting at the middle. You've got money dumping out into paying for things, putting funds in inventory. So inventory, receivables, and payables are the components in the order to collect, which is the receivables process, and the procure-to-pay or order-to-pay process is another element of that. So all of those fit tightly together. Why is it important? Is if you're inefficient in that process or unthoughtful in that process, you put too much money into certain elements of that, too much money into receivables. You made the trading terms too loose. People aren't paying you in time. Now you have a lot of cash tied up in there. You're not nearly as efficient. That has an impact on both liquidity as well as your overall, capital efficiency and ultimately the value of the firm. And that holds true on, inventory, et cetera. At the same time, if you are too parsimonious about putting money into the business, like, hey, we don't want to offer anything on credit terms, well, business is going to go elsewhere for the most part, unless you command, you're in a certain industry or you command a certain level of attention or have something unique. They're going to go elsewhere because, like, I can pay 45 days over here. You require payment up front. I think I'm going to go to someone who's a little more willing to work with us. And that can be true with inventory. It's like, let's cut inventory down to nothing. And if I don't put money in inventory, I'm going to lose sales because I don't have stuff ready because now I have to make it. Or it's, 10 days to ship it as opposed to it's, the washer, dryer you pick up is available immediately. So it's important because you need to optimize those things, optimize the balance of cash, and you need to have an efficient process of moving cash in and out of this cycle. That's at least a start. I don't know if I covered everything you wanted me to, but
you unpacked quite a bit, and I was just sitting here thinking as you were talking about this. When COVID hit, there was a huge disruption to supply chains, and it just makes me think about, was this beneficial to these Fintechs that provide supply chain financing platforms for managing their supply chain? Have we seen an increase, or has it been a boon to these Fintechs? More organizations going, hey, we're in trouble. We need something to manage this more effectively. Did COVID, with this disruption, did it lead to greater use of these platforms?
Yeah, there certainly has been. I mean, COVID COVID was one of those triggering events. People started working from home. They still needed to do business, to pay and get paid. Not everything was coming in. So the implementation of these products, we saw it as about 2.5 years worth of growth over about a year. Just people putting these in. Why was that necessary? Well, the not present was a forcing factor, right? We needed to make sure that things got processed. And so putting in tech helps with a good chunk of that type of work. The second factor is efficiency, not so much related to COVID, but related to an organization's ability to scale. The more manual a process is, the more errors there are going to be. Errors have several negative impacts. One is it's more costly, and it also ruins and harms your cash efficiency, right? Errors don't just, an error delayed things 5 days. Well, it usually starts the process over and takes 30, 35, or 45 days for payments to come through on the back end of that. Oftentimes, it just has an outsized impact on the cash on that. So organizations need to be able to scale. If you look at AR groups and AP groups, one of their top concerns is always efficiency. Secondary concerns, still very high, are fraud and then efficiency, the ability to scale. You can't just say we're going to double and then we're going to double the size of our staff. You want to be able to take on, manage regular growth, take on new businesses very efficiently. So maybe it's, if you double in size, you increase your staff by 1/8, let's say 12.5% or smaller. And so this drive to efficiency by using these types of tools on the procure-to-pay, order-to-collect processes allow for that greater efficiency, greater scalability. Most organizations are scaling and plan to scale. And so how do you continue to achieve efficiency over time? Everyone has to achieve efficiency over time. We see that in GDP statistics. How has efficiency of the labor force improved? We need to do that everywhere. That's certainly an area of attention in AR and AP groups. And I think that answers most of what you asked. And if there's a few other things you want me to cover in some more depth, I'll be happy to jump in.
Yeah, you mentioned efficiency quite a bit. You also mentioned capital. I think both are important, but is it efficiency or capital, or is it efficiency and capital, or something else?
Yeah, for almost all companies, it's going to be both. There's sometimes where the capital is the number one concern. It's liquidity. And so shaving, half a days or portions of days off of your DSO will be not just survival feature, but the reason for all of the actions over a particular year. For other organizations, it's we need to reduce our costs. Our margins are very thin. We need to continue to be able to ensure our organization can grow. We'll grow to success by growing in efficiency. And so those may be very weighted towards the efficiency side. But for the vast majority of organizations, and certainly over time, both of those have to be held in tension or advanced at the same time. Maybe not at the same rate, but at the same time. You can't manage your capital well if you're inefficient in the process. There's that follow-on effect. If you're not billing immediately or billing accurately or shipping accurately, that's going to impact your receivables. It's going to impact your customer relationships. Bad invoices and errors, these defects, has a follow-on effect onto the capital side. So most certainly it has an impact there. So they can't be completely isolated. They're usually held in balance. May go 60-40, maybe it's 50-50 in a particular year, but both of those are going to be a focus. So it's both and for most organizations, but it might be weighted more heavily on one or the other for different periods of time. I do want to talk about SCF a little bit, if that makes sense on this question, because
definitely makes sense. I think it's something that I think organizations, especially manufacturers or anybody that's taking an input to produce something, really important to them. So yeah, I'd like to hear what your thoughts are on that.
Yeah, so when you ask that question about is it efficiency or capital, it's either both and. It's when we think about the trade, if I pay you sooner, you're happy, I'm not happy because cash left me. If I pay you later, that's helped my balance sheet, but that's harmed your balance sheet to some extent. And there's an element of it's a win-lose, right? It's directly proportional. When we look at being efficient, that helps everybody win up to a point, right? To being efficient, you still want to pay according to terms. You want to make sure things are communicated. You reduce the defects. You're a better trading partner. What SCF does is it steps into this exchange of money and time. And instead of having two parties, there's three parties. And that's where the shift can occur. Someone can occur. It's like, hey, maybe I need to, instead of paying in 30 days, I need to move that up to 75 or 90. Well, that will break my suppliers. That's not going to be accepted. That's going to create, I'll call it ruinous increase in pricing, because they're like, hey, you're making me finance, 2 months of what I sell to you. That changes the economics. Now I'm not going to price that so well. And so what can happen here is maybe I want to pay later, but I want someone else in the midst of it. Maybe I have good credit, as an example. And so I get a third party, an SCF vendor who maybe I'm paying them at 90 days, but the SCF vendor offers a scale to the recipient. So instead of getting paid in, let's say 45 days, whatever the example I was, instead of getting paid 45 days, they could take payment in 90 days. They could take payment at 60 days or 45, what's been historically. What if they wanted to take it in 15 days and it's approved? They could take it at a further discount. So now what does that do? You might say, well, I don't want to do that. I want to get paid the full amount according to the terms. Well, this gives them additional flexibility. And if the person offering that, working with let's say a financing party is available, they may offer better rates, effective rates than the supplier company can get. Therefore, if they need money sooner, and on day 15, they're like, hey, I'm going to have to tap a line that's expensive, or I'm going to have to make some kind of adjustment that's very uncomfortable, or I can receive my funds sooner for a small discount. I need them 30 days early this month. I pull them in earlier. Now I had access in a very affordable way to more funds. So now I have more flexibility. Adding that third party makes it so it's not just either or, win-lose between two parties. It provides some additional flexibility that has an impact on liquidity. Liquidity generally, and being more flexible is certainly more advantageous. So that's another area of both efficiency and working capital and changing how the equation is set up because you added another party.
I think that level of flexibility has got to be really important when it comes to supply chain, because things change for organizations. It could be that demand is slowed. It could be that demand is increased. Having the ability to be flexible and be able to fund or finance the activity that's occurring at whatever level seems like it's really valuable and important to organizations. When it comes to liquidity management and scalability, that's kind of what that seems to speak to. And liquidity management for any organization that is a manufacturer seems like it's really important, or a supplier. Got to be really important to them. How does the cash conversion cycle come into play here?
It's a related question, or a cousin question, if you will, to your efficiency and capital, either or. Liquidity management is not just, Treasury handling the investments and the borrowing side. That's a huge core and central component. The capital structure, and using the debt and capital markets is a core of liquidity management. But if you ignore the business side, the cash conversion cycle, that has a direct impact on the liquidity, the overall liquidity, the flow of funds in and out. And if you look at different industries, it can matter more or less. Like a manufacturer, maybe very tied up in very capital intensive industry. And so receivables, payables, for example, has a bigger impact than, let's say, an investment oriented organization like an insurance company, a property casualty insurance company. And so if we look at different organizations, we have to consider their different needs and drivers differently. But from a liquidity management and scalability perspective, the cash conversion cycle feeds into liquidity management. Working capital is part of liquidity management. Your borrowing capability, your investment activity all ties into, both operational cash and longer term planning. On the scalability side, if you don't have an efficient process and, let's say it works, but you're barely changing with your flows of inventory, receivables, payables, your business is extremely static, you won't notice a lack of scalability as much. But if you're able to scale as a business rapidly and you have reached the peak of your efficiency, you are going to become extremely inefficient when you grow 30% or 50%, or you take on a new organization. And that's not what the expectation is on treasury groups, the office of the CFO. They're expecting quite a bit more scalability, to take on more without breaking the process, without saying, oh, now we can't bill properly, or now we can't bill on time, or we can't resolve issues or disputes, and vice versa on the other side of the equation. So those will create a massive drain on capital if you're inefficient. It always seems to work that way, right? If you're inefficient, the process is going to break if you scale rapidly. If you're very stable, that's not necessarily going to be something that's noticeable in a change. It's just an efficiency play, but efficiency and scalability means you can continue to be efficient as the volumes fluctuate greatly. And that's another piece here. How are you going to do that? Is that just internal efficiency? Is it leveraging different types of technology and technology providers to do that, right? There's a built-in aspect. When you use a third party, the scalability challenge becomes their challenge. You pump more volume through. Your increase of 50% during a mid-month peak, if you handle that internally, you've got to hire temporary workers or hire a much larger amount of people to handle that peak, or spread it out over more days. Either way, that's efficient. Well, your 50% bump, let's say in the middle days of the month, now it goes to another party, and to them it's a fraction of a percentage, and they're managing it with other activity. I'll mention too, Paul, on page 39 of the analyst report, 38 and 39, you see the vendors, you see the technology categories. Some examples of those on the supply chain finance and cash conversion cycle solutions, identified in the purple column. You'll see Deluxe, you'll see Flywire, LSQ. There's also some in the Treasury ecosystem side, which we're going to be talking about later. And you see you'll see some overlap between ecosystem and the cash conversion cycle supply with, things like, with things like cash and security and other features. So I just point that out to the audience.
Yeah, thanks for pointing that out, Craig. The analyst report's got so much information in it, super valuable for treasury teams out there, whether they're looking or they're just wanting to stay up to date on treasury technology. That analyst report is very valuable. At the end of the podcast, you can go to the show notes. You'll find a link where you can get a copy, download a copy of the analyst report. You can go to our website as well and get additional information. One last thing here, Craig. This is something that would certainly be newer the last 12 months. Artificial intelligence has increased in its acceptability and its use. Still has a way to go, a lot more to learn, but it's continuing to evolve. How does that come into play, and how can that be used during the cash conversion cycle or in the instance of supply chain financing?
No, that's good. I was going to say, I told you not to ask me about AI. Yeah, certainly. I mean, AI has been around in some of these areas on the cash conversion cycle for multiple years. When you look and examine and see what some of them have been doing on the receivable side, for example. What do you need to do on receivables? Well, you need to know when does it make sense to send an email, an automated email, send a custom email, to call, to have a relationship person call. The other factor too, in addition to that type of activity, when you're making projections about what is our cash flow going to look like as you prepare for, end of the month, Some people call it dialing for dollars. They're trying to get things collected, especially at the end of a quarter when everyone's holding back their payments. Not everyone. We have stats on percentages, but when there's delays on payments, what do you do? The use of AI has been really interesting because how did people plan for that? When you had many individual companies, let's say of moderate or small amounts, well, you would use things like regression analysis, which is helpful when you have lots of small bits of data and you need to crunch them together. You have some models that allow you to do that at a macro level. What if you could do that at an individual level, individual client level? And if you knew when they paid, what their history was, the different factors, not just day of the week, but holidays, quarter, and other information, if you could have a system make estimates very accurately at an individual level, would that be more accurate than using some things like regression? Once you have more data and the ability to run that, the use of AI outstrips what regression analysis can do on the forecasting side. But it allows you to play and model those two together and see how you can be more accurate. More accurate with your forecast and model helps Treasury significantly. More accurate with the analysis and determination of who you call and follow up helps you be judicious with your time and your activities for your AR collectors, the collection group, the ones that are dialing for dollars or following up, to leverage both technology and when a human needs to get involved to do that a sharp and smart manner. AI is working well. It has to play with a lot of data. The data's got to be clean. Usually these tools, the order to collect, order to pay, anything in the cash conversion cycle, are now capturing more and more pieces of data either within the system themselves or gaining access to your procurement, all the way through procurement, payment, collection, all of that activity. And the more information that you can feed it, refine it, and train it, the more that's going to benefit you for things like activities, forecasting, identifying and doing better on that through variance analysis and discrepancies, or identifying potential problems, maybe credit problems. There's maybe a softening condition that might be just temporary or might indicate something more serious. There's just a lot that can be done with AI. It's just a super powerful tool that allows you to look through these areas far more rapidly on a reiterative basis. So a huge amount of promise. And there's a significant amount of benefit today already. So this has been around for a while in some companies. Other companies are dropping it in. Very fast developing tool, already making an impact. It's not future. Future will be greater gains, but there's already significant gains already in the space.
Efficiency, accuracy, visibility. All very nice features to have with a new technology. Certainly something that's evolving. As a reminder, you can download a copy of our analyst report, go to the show notes, click on the link. You can go to our website, get additional information as well. Want to note that Q1 of 2025, Craig and I are coming back with 3 webinars. First one will be January 8th at 2 p.m. Eastern Standard Time. We'll talk about Treasury management systems, Treasury risk management systems. On February 5th at 2 p.m. Eastern Standard Time, we will cover Treasury Aggregators. And then again on March 5th at 2 p.m. Eastern Standard Time, we'll be talking about subject we just covered today, supply chain finance, cash conversion cycles, as well as upcoming podcasts on Treasury ecosystem. So we got 3 webinars, Q1 of 2025. Please join us for those as well. Craig, I thank you for joining me on this podcast today. Great information, good conversation.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.